Ever felt like the world of finance speaks a language you don't understand? Don't worry, you're not alone. Let's break down two of the most common terms you'll hear. Stocks and bonds. Imagine the words stocks versus bonds scrawled on a board in crayon. A big curious question mark pops up, then cleverly transforms, splitting into a rising stock chart on one side and a formal bond certificate on the other. It's simpler than you think, and understanding the difference is the first step towards smart investing. So what exactly is a stock? Think of it as buying a tiny piece of a company you believe in. When you buy a stock or a share, you become a part owner. Picture someone handing over some cash and receiving a small symbolic slice of a big corporate pie. This ownership means you have a claim on the company's assets and a share in its profits. If the company does well, the value of your piece can grow, sometimes significantly. We can visualize this with a graph rocketing upwards, showing that high growth potential. Plus, some companies share their profits directly with shareholders through payments called dividends, like little coins dropping into your pocket. It's about betting on a company's future success and growing with it. Now let's talk about bonds. A bond is essentially a loan. Instead of buying a piece of an entity, you're lending money to it, which could be a corporation or a government. Imagine handing over your money, and in return, you receive an IOU, a formal certificate that promises you'll be paid back. But that's not all. For letting them borrow your money, the entity agrees to pay you interest over a set period. We can see this as a calendar, with payment dates marked regularly. These are called coupon payments, and they provide a predictable, steady stream of income. At the end of the loan's term, known as its maturity date, you get your original investment, the principal, back in full. It's less about high-flying growth and more about reliable, fixed returns. So, what are the key differences? Let's put them side by side. On one side, we have stocks, which represent ownership. You're a part owner of the business, sharing in its potential triumphs and its risks. This comes with higher potential rewards, but also higher risk. If the company performs poorly, your investment could lose value. On the other side, we have bonds, which represent a loan. You're a lender, not an owner. This generally means lower risk compared to stocks. Your return is the fixed interest you're paid, not a share of the profits. You get a steady, predictable income, but you won't experience the explosive growth a hot stock might see. It's the classic trade-off: higher risk for higher potential reward with stocks versus lower risk for more modest, stable returns with bonds. In the end, it's not always about choosing one over the other. For many investors, the secret lies in balance. Think of a classic scale. On one side, you place stocks, with their potential for exciting growth. On the other, you place bonds, providing stability and income. By combining both in your investment portfolio, you can create a strategy that's tailored to your own financial goals and comfort with risk. This approach, known as diversification, helps smooth out the ups and downs of the market. Understanding these fundamental building blocks is your first step on the path to building a stronger financial future.